everyone. Good morning, or good afternoon, or good evening, depending on which time zone you are from. Great to see all of you again, and welcome back to day 2 of the Black Market event. I hope you guys caught day 1. Did you guys catch day 1? Where I talked about how to invest in the top 1% of the best companies in the world. And that's how you generate consistent profits as an investor. And then we had Alson Chu, who talked about price action manipulation. If you missed day 1, we will send you a limited time replay. So don't worry too much about that. So for today's session, I'm going to focus on how I trade options in a way that helps me to generate very consistent source of income. Few $100,000 a year, even during the bear market last year. And the way Bang Pham Van, our chief options strategist, and the way I trade options is very different from the way most retail traders trade options. Most people, they buy options. We hardly buy options. We tend to focus on selling options. So where most people are using options to gamble at the casino, we are very different. We don't believe in gambling at the casino because we are like the casino. We are like the house. And as you know, the house always wins in the end. So today we're going to share with you, between myself and Bang Pham Van, will be up in the afternoon. We'll be sharing with you the different ways in which we trade options. That's very lucrative and very consistent. Yeah. By the way, how many of you here are new to options? You're totally new. You don't really understand options at all. Any of you here? New to options? Okay. So if you are someone who's learning options for the first time, I must tell you that it can be a bit challenging and sometimes a bit confusing at first. When I first learned options about 18 years ago, I was completely lost. I was completely confused. And I had to run through the materials, again and again and again until I could understand. So either I'm a very slow learner or my teacher was not very good, all right? But today, I'm going to do my best to teach you options in as simple way as possible. So my goal today is for you to really understand the concept of options. So like I said, it took me a bit of time to learn options myself. It was not easy for me initially, but once I got it, once I could understand options, it was a game changer for me. It totally transformed the way I invested, the way I traded. And today I can tell you that a big chunk of my profits, of my investing and trading success comes from options. I can't live without options today. In fact, I trade options almost every single day, and it's a big source of my consistent income. Yeah. So we're very excited to share with you again how we trade options. So if you have any questions, please ask in the chat box. My team is behind to help you to answer those questions. Take lots of notes, and of course, take advantage of our very attractive black market discounts that happens once a year, where we have got up to 75% off our courses and mentorship playbooks. Yeah. So remember, as I'm teaching you options, if you feel a bit confused, there's nothing wrong with you. There's nothing wrong with you. It's very normal. Okay. So I want to encourage you, don't give up. Don't say, oh, it's confusing. No, don't give up. Ask questions until you get it. I tell you why. Because to me, if you want to be a very successful investor and trader, options is an essential skill. It's something that to me, it's a must to learn if you really want to master the markets. How many of you here can drive a car? How many of you here can swim? Now think about it. When you first learned to drive, was it easy? No, it wasn't. To many people, it was very challenging. Was swimming easy? Again, to many people, it was not easy, right? But why is it many of you can swim and many of you can drive a car? It was not easy to learn. How come you can do it? Because to many people, we say to ourselves, it's a life skill. We have to learn how to drive. We have to learn how to swim. So when something is a must in our life, we will do whatever it takes to learn it. We will not give up. Correct? So it's a question of, is it a must for you? So I'm here to encourage you that learning options is a must if you really want to get very high returns in investing and trading. Yeah. So again, I'll do my best to teach it to you in a way that a toddler can understand. Okay, I'll do my best. Yeah. But again, please ask questions to clarify along the way. So let's begin by first asking this question: why learn options? What's so good about options? Well, in general, options are a tool that allow you to profit under all kinds of market conditions. So whether the market is bullish going up or bearish going down, whether the market is going sideways, whether there's high volatility, low volatility, there are different option strategies to profit in different market environments. So you don't have to only wait for the market to go up to make money. In a sideways market, you can make a lot of money with options as well. In a bear market, you can also make money with many option strategies. So it's very flexible. It's like a Swiss Army knife where you've got all kinds of tools in any situation. Yeah. And options, if used properly, can help you to actually lower your risk. Yes. Some people say, but aren't options risky? Well, if you don't use it the right way, of course it's risky. It's like fire. If you don't use fire the right way, it can burn you. But if you use fire the right way, it can cook a good meal, right? So when you follow the rules of how to trade options the right way, options can actually lower your risk and lower the capital required to invest or to trade. And again, I'll give you lots of examples later on. Next, options can also increase your ROI, your return on capital, your return on investment. And options can also massively increase your win rates. Most of the time when you are trading stocks, no matter what fantastic method you use, your win rate is not 100%. At the very most, when you trade stocks, your win rate is 50 to 60% win rate. Even the best traders in the world get a 60% win rate. But with certain option strategies that I use, like credit spreads, or Bang is going to teach Jade Lizard later on, the win rate is 70 to 90% win rate. That's why Bang, Fambam, and we love using these particular strategies. Instead of trading the underlying stock, we use options because it increases our win rate, all right? So how do we actually use options? Now, some of you here may be more of investors. You buy good companies, like what I talked about yesterday, and you hold it for the long run, right? How many of you here are investors? Okay, just buy it and hold good companies through the ups and downs, okay? Now, some of you may be more short-term traders, where you want to get in, get out, get in, get out, short-term trading. And of course, some of you, like me, you do both. You do both investing as well as trading, all right? So whether you are investor or trader, there are many ways to use options. So for investing, there are three main ways investors use options. The first is by earning monthly income, selling covered call options. That's one method. Now, again, don't worry too much about how is this done. I'm just giving you an overview and a general idea. Later, we'll go into the exact step-by-step, yeah? Number two, investors also use options to get paid every month, waiting for the stock to drop to the level they want to buy. So we call that selling cash secured puts. And in fact, this is my favorite method that I'm going to focus on today. And the third thing that investors do is they also use options to hedge or protect their portfolio during short-term corrections or during bear markets. So three ways investors use options. Now, how about short-term traders? For short-term trading, there are also three ways to use options. Number one is for directional trading. What's directional trading? It's when you're betting on the stock going a certain direction. Like if you think it's an uptrend, you want to go long. If it's a downtrend, you want to go short, right? That's called directional trading. You're picking a direction. So instead of, again, buying the stock, you can use option strategies like debit spreads and credit spreads and diagonal spreads and bullish synthetic spreads. I know it sounds a bit complicated. Don't worry too much about it. But again, why use these options? Why don't just buy the stock? Because again, I'm going to show you later on that by using credit spreads, for example, you can get a very high win rate of 70 to 90%, right? And with like bullish synthetic, which I use as well, you just need to use 20% of the normal capital required when you buy the stock. So it uses a lot less capital and increases your return on your investment. Yeah. Now, options can also be used for non-directional trading. What's non-directional trading? That means when the market is going nowhere. If the market is going sideways and you buy stock, you can't make money, right? So with options, you can use strategies like Iron Condor, Snipex, calendar spreads that make a lot of money when the market goes nowhere, right? And the third thing is we can use options for event-based trading. Like for example, if the company is going to announce earnings, if the company announces good earnings, the price can gap up, correct? If the company announces bad earnings, the price gaps down. Now the problem is you can't predict. You don't know, is it going to go up or go down, right? But whatever happens, before the company announces earnings, guess what? The volatility of the market will go up. And that's how we make money through event-based trading. We trade around a certain event. And we have got strategies created by Bang Pham Van, like the earnings probability spread and the earnings sniper spread. So these are strategies where you can make money from an event without knowing the outcome of the event. Okay, so this is a general overview of the different ways we can use options. Now, like I said, options has been very good to me. I have generated very consistent income every single year, even during the bear market. Last year, 2022 was a bear market. So my stock investments, which I held, went down in value temporarily, but this year they've gone up, right? But while my stocks went down last year, I made a lot of money trading options. Okay, so these are my options trades. This is my trade summary from Interactive Brokers, and this was last year. You can see from January to December 2022. This is one of my accounts with my wife. That's my wife, by the way, right? And this is the total. At the bottom, you can see my total options sold, which is $1.135 million worth of options I sold. And options I bought 867,000, which I had to pay. My net profit for this account was $267,000 US in a bear market, right? This is one account. My second account, which is this one, all right? Again, January to December last year, total options bought 1 million, sold 1.2 million, net profit 220,000 US. My two accounts combined, my total combined profit was 448,000 US last year in a bear freaking market, right? So the profit that I earned from these options helped to offset my temporary drop in my stock portfolio, all right? That's why I love options a lot. Now this year, of course, this year, bull market, right? So make more money, right? So far this year, January to November 14, I just printed the most recent report. I bought 1.3 million in options, and then I sold, made 2 million in the options. My net profit, 681,000 US dollars. Okay. Now, guess who else makes a lot of money trading options? Guess who else makes a lot of money trading options? Even more than me. Even more than me. Guess who? Bang Pham Van? Correct, right? But who makes even more money than Bang Pham Van? This guy called Warren Buffett. Did you know that Warren Buffett is the world's biggest options trader? Yes. Many people always think that Warren Buffett, he just buys stock and sit on his ass, right? Because that's what he always talks about. But many people don't know that Warren Buffett trades a lot of options, but he never talks about it. The sneaky guy, right? But if you read the annual report of Berkshire Hathaway, you can see that he trades a lot of options. And he uses the same approach that I use and Bang Pham Van. Warren Buffett never buys options. He never buys options. He sells options. Specifically, he focuses on selling put options on the index and on individual companies that he wants to buy. So this is the exact method I'm going to teach you today. And this is the method that I focus on as well. Cool? All right. So with that quick introduction, let's really understand what are options. And again, if you are a beginner, I'll do my best to go step by step. Now, what's an option? An option is a contract. Just remember, it's a contract. And you can buy this contract or you can sell this contract, okay? And there are two types of option contracts. First are call options. Everyone do they say call? Right? Calling is like buying, right? And then put options, put is like selling, okay? So let's talk about call options first. What's a call option? Now, when you buy a call option, you are buying a contract that gives you the right, to buy 100 shares of a particular stock. Now remember, in options, one contract is always 100 shares. Okay, it's always 100 shares. So if you buy a call option, you have the right to buy 100 shares of a particular stock, let's say Apple, at a certain price that you predetermine, that you locked in. So we call that the strike price. So you can buy 100 shares of Apple at a certain price you locked in anytime before the option expires. And you can choose whatever expiration date you want. Yeah. So let me give you an example. Okay. So if you buy a call option on Apple at a strike price of $190, what does it mean? That means that you have the right to buy Apple shares at $190. You've already locked in the price. Okay. So if Apple goes to $290, you can still buy the shares at $190. If Apple goes to $1,000, you can still buy the shares at $190. So no matter where Apple goes, you can still buy it at $190 because you have locked in the price by buying the call option. Got it? But of course, to buy the call option, you have to pay a premium in order to lock in the price. Yeah? So for example, let's imagine that Apple now is at $190. The stock price is at $190. So you buy a call option at a strike price of $190 to lock in that price. And let's say Apple goes up to $290. Are you happy? If Apple goes to $290, are you happy? Yes. Why? Because you have the right to buy it at $190 when now it's at $290, right? So theoretically, you could exercise the option, buy the shares at $190 and sell it at $290 in the market, making a profit of $100, right? So in other words, remember this. When you buy a call option, and the stock price goes up, the more that the stock price goes up, the happier you are, the more profit you make. Got it so far? So I repeat again. When you buy a call option, the more the stock price goes up, the more the call option is worth. So that's simple. We all understand that? Cool. Okay. Now, let's go to put options. What's a put option? It's kind of like the opposite. Yeah. So when you buy a put option, you have the right. You have the right to now sell 100 shares of a particular stock. Let's call it Apple again. Anytime before the expiry date, and you can sell 100 shares of Apple at the predetermined price that you locked in. Again, we call that the strike price. You can choose whatever strike price you want. Okay. So again, let's imagine Apple is at $190 now. And you decide to buy a put option an Apple put option at a strike price of 190. So what does this mean? That means you now have the right to sell Apple shares at 190. So if Apple drops to zero, if Apple goes to zero, you don't care because you can still sell Apple shares at 190. If Apple drops to $50, you also don't care because you can sell Apple shares at 190 because you've already locked in the sales price. So anytime before the expiration date, you can sell Apple shares at 190. Understand? Okay. So if Apple is now at 190 and you buy an Apple put option at the 190 strike price and you lock in that sales price, and if Apple drops to $90, are you happy? If Apple drops to $90, are you happy? Yes, you're happy, right? Because theoretically, you could buy the Apple shares at $90 and then exercise the put option contract and sell the shares at 190, making you a profit of $100. All right? So in other words, when you buy a put option, the more the stock price goes down, the more the put option is worth. All right? So let me show you over here. When you buy a put option, you can see that the more the stock price goes down, right? When the stock price goes down, the more profit that you make. Can you follow so far? When you buy a put option, the more the stock price goes down, the more the put option is worth. Okay? So what do most retail traders do? What do most amateurs do? Most amateurs say, okay, so if you think the stock price is going up, what do most people do? They buy the call option. If they think the stock price is going to go down, they buy the put option. That's what most people do because that's what most option courses teach you, right? But I can tell you, now I used to do that many years ago when I first started. And if you do that, chances are you will lose money eventually. Over the long run, you will lose most of your money if you do this. Why? Because what a lot of these gurus don't teach you is that, let me explain. Now, the trouble is when you buy a call option, okay, watch carefully. When you buy a call option, okay, the problem is a call option has an expiry date. And an option is a decaying asset, which means every day you hold the option is losing value until it expires worthless. Okay. Now, to make money on a call option, not only must the stock price go up, but the stock price must go up fast enough before the option expires. If the stock price goes up, but too slowly, the option expires, you also lose money. Understand? So not only must you be right on the direction, you must be right on the speed that the price must go up very fast. Okay? So very often when people buy a call option, the stock price goes up, but too slow, and the option is worthless and they lose money. The second thing you must understand is that the stock price must also go up significantly, enough to cover the cost of the call option. If the stock price goes up a bit, you also lose money because it's not enough to cover the cost of buying a call option. Do you follow so far? Okay. So when you buy a call option, the chance of making money is very low because not only must the price go up, the price must go up very fast and the price must go up significantly. Yeah. And that doesn't happen very often. That's why buying a call option is like buying the lottery ticket. Yes, once in a while when the price goes up a lot very fast, you can make a lot of money. But that doesn't happen very often. Most of the time, the price goes up very slowly, doesn't go up, and you end up losing money with call options. The other thing that you also must understand is this. Remember, when you buy a stock, there are three things that can happen. Number one, a stock can go up. All right, that's the first scenario. Number two, a stock can go sideways. Right? It goes like that, sideways. Or number three, a stock can go down. Right? There are three things that can happen. Now, when you buy a call option, when do you make money? When do you make money? You only make money if the stock price goes up fast enough and big enough, right? You only make money here. But if the stock price goes sideways or goes up a bit only or goes up slowly, you lose money. And if the stock price goes down, you also lose money. So can you see that when you buy a call option, you only make money in one of three scenarios? You only make money in one of three scenarios. How many of you have heard before that 80% of options expire worthless? Have you guys heard of this before? 80% of options expire worthless, which means if you buy an option, 80% of the time in the long run, you become worthless and you will lose money. Okay. Now, then you got to ask yourself, if people who buy call options in the long run, if they lose money, who's making the money? If the guy buying the options in the long run is losing the money, who's making the money? The guy making the money is the guy who's selling the options, which we'll talk about in a short while. All right. But first, do you understand what I'm talking about here? Why buying call options sounds interesting, sounds good, but in reality, it's very hard to make money from buying call options over the long run. Do you understand, everyone? Okay. Now, the same thing with buying put options. Now, again, remember, the stock can go up. The stock can go sideways. Or the stock can go down. Three scenarios. Again, when you buy a put option, when do you make money? When you buy a put option, you only make money if the price drops fast enough and significantly enough. If the price drops a bit or drops slowly, you also don't make money, right? So you only make money in scenario number three. If the stock price goes up, you lose money. Stock price goes sideways or goes down a bit, you also lose money. So same thing, when you buy a put option, you only make money in one of three scenarios. When I first started trading options 18 years ago, I did the exact same thing like most people. I thought stock's going to go up, I buy call option. Stock going to go down, I buy put options. And I lost a lot of money. I lost a lot of money. I blew a lot of accounts and I thought something's wrong with me. I'm so unlucky. Why am I so stupid? Then I finally realized that there was nothing wrong with me. It was not because I was unlucky. It's because I was like the person going to the casino playing jackpot, right? If you play jackpot once in a while, you get a payout. But over time, you lose money by putting in those coins, right? And I remember there was one time I got to know some professional option traders working for institutions and banks. And I was actually at a karaoke with them, right? And I told them that I was buying options. I was buying call options in the market. And they all laughed at me. They all laughed at me. They say, Adam, you are an idiot. You are an idiot. I say, huh? Why am I an idiot? They say because people who buy options, they are like gamblers. In the long run, the gambler always loses. But they say, we are the ones who are the bankers, the institutions that are selling you the options. We're like the casino. We always win in the end. And that is what totally changed my mindset. And when I started to trade like the institution, when I started to trade like the way the banks trade options, that's how I made money consistently every single year. Few $100,000 even in a bear market, right? And the funny thing is that Bang Pham Van went through that same exact experience. And when we both got together, we say, yes, you know, we both went through that experience. And that's why since then, we now teach our community, our students, on how professionals really trade options. Got it so far, everyone? Okay. So between Bang Pham Van and I, like I said, our approach to options is we very, very, very rarely buy options. Very rare. Most of the time, we sell options. But please be very careful. Write this down, write this down, write this down. Never sell options naked. Never sell options naked. If you sell options naked, it's extremely risky. And in the end, you become naked yourself. You'll become bankrupt. Okay? Selling options can only be done when you are hedged. I repeat, you can only sell options when you are hedged. Now, what the heck does that mean? Later, I'll go through step by step what I'm talking about. All right? So please do not say, oh, Adam said sell options. You sell options naked and you die. Please do not do that. Please learn exactly how we sell options in a very, very safe way that is hedged. All right? Now, so I sell options almost every day. And 99% of the time, I'm selling put options. That's right. 99% of the time, I'm actually selling put options over here. So if you take a look at this box, you can see, why do I love to sell put options? Why? Because remember that in the long run, market always goes up and good companies always go up, right? So when I sell a put option on good companies and on the index, notice what happens. When the price goes up, I make money. If the price doesn't go up, the price goes sideways, right? The price goes sideways, I also make money. Now, some of you would say, but Adam, what if the price goes down? If the price goes down, you can lose money. No. Even the price goes down, I also do lose money. How? Okay, I'll show you in a while, so hang on, all right? So far, are you following me, everyone? Can you follow? Or are some of you like lost? Can follow, very good. Okay, so let me carry on. So you can read a lot of our sharings from students, how the course transformed the way they trade options. This is Marie, who took our options course a couple of years ago. And she said, I've been trading for years, but I only knew single calls and puts. I was making a lot of money. Then I lost almost all my profits. After that, I made more money, but then I lost profits again. I was just going in circles. How many of you have experienced this in trading or options trading? You make the money, then you lose the money, you make the money, lose money. And then basically you never make money and you're like going in circles. All right. And then she said, after I joined Piranha Profits in 2020, I studied so hard to master option strategies. Under Bang and Adam's guidance, I'm making consistent profits with confidence without any stress. Now I can sleep through the night, and every day I'm so excited to trade and invest without any fear. This year alone, in 1 month, I'm up more than $35,000, right? So since 99% of the time I sell put options, let me spend more time to explain put options, right? So ready, listen, write this down, very important. So once again, what is a put option? Okay, when you buy a put option, you are buying a contract that gives you, the buyer, the right. You have the right to sell 100 shares of a particular stock at a predetermined price you locked in. Again, we call that the strike price. So you can sell the 100 shares at this particular price anytime before or on the expiration date. And again, you can choose whatever expiration date you want for the option. Yeah. Now, let me explain in a very simple way. A put option is basically an insurance contract. Okay, write this down. A put option is basically an insurance contract. When you buy a put option, you're buying an insurance contract. Let me give you an example. Let's imagine you own a house and your house is worth $1 million, but you live near the forest and there's a lot of fire recently and you're afraid that the fire will burn your house down. What do? You buy fire insurance, correct? You pay a premium and you insure your house for $1 million. So no matter what happens, you can sell your house for $1 million. You locked in the price of the house. So if the fire comes and burns down half your house, Now your house is worth 500,000, right? But because you bought the insurance on the house, you are not worried. You can still sell the house at $1 million. Do you follow? Do you follow that? Okay. So same thing in the stock market. Same thing in the stock market. In a stock market, if you own Apple shares at 190, let's say Apple is at 190, and you think that Apple shares will drop for whatever reason, you buy a put option on Apple, which means you're buying insurance on Apple. You are locking in the value of Apple at 190. It's like you're buying insurance at 190. So even if Apple drops to 0, you don't worry. You can still sell Apple at 190. Understand? Right? So that's a put option. Okay? So this is an example of a put option. So again, let's imagine that Apple is now at $190. That's the stock price. And you are very scared. You think, oh, Apple will drop. Oh, okay? So you buy insurance, okay? So you buy the Apple 190 put option. So what does this mean? It means you buy a put option at the 190 strike price to lock in the sales price. And this option expires in August, on the 3rd Friday of August. Now, options always expire on Friday. Options always expire on Friday. Huh? Now, when you buy insurance, you have to pay a premium. Same thing, when you buy a put option, you have to pay a premium. In this case, what's the premium? The premium is $5.70 per share. Remember, one contract is 100 shares. So you must always multiply by 100. So to buy this contract is $570. All right? Okay. So let's say you buy this put option and Apple drops from 190, Apple drops to $90. Are you happy you bought the put option? Are you happy you bought the put option? Yes. Why? Because you have the right to sell Apple at 190, but now Apple's at $90, right? So theoretically, you could buy Apple at $90, exercise the put option, and sell the Apple shares at 190, making a profit of $100. Okay? So in other words, your put options are worth at least $100. But in reality, they'll be worth more because of the remaining time value. But they'll be worth at least $100. We call that the intrinsic value of the option. Okay? So you bought the put option at $570, right? Right? But now the put option is worth $100. So what could you do? You bought the put option at $570. Now you sell the put option at $100. So what's your profit? What's your profit? Your profit is $94.30. Got it? Now, in reality, when people buy a put option, they don't actually buy the shares at $90, exercise the put option, and then sell it at 190. They don't actually do that. It's only in theory. In reality, people who buy put options, they don't actually buy the shares. And they don't actually sell the shares. They just buy the put at $570, and they resell the put at a higher price when the put increases in value. Okay? So that's what you have to understand. Now, what if after you buy the put option, Apple doesn't go down? Apple stays at 190. It just stays there. Or it goes up to 191. And then the option expires. Are you happy now? No, right? Because you have the right to sell Apple at 190, but now Apple's at 191. So what happens is the option will become worthless at the expiration date. When the option becomes worthless, how much do you lose? how much do you lose? How much do you lose? You lose your $5.70. It's the same thing as you buy the fire insurance on your house. You pay the premium every year, but your house don't burn down. At the most, you lose the premium. Right? Okay. Do we understand this so far? Understand? Okay. So let's now move on to this next part. Now, in the market, you can play two roles. You can either be the person who buys the put option, that means the person who buys insurance, or you can be the person who sells insurance, who's the put seller. All right, you can play either role. Now, some people would ask this, Adam, must I first buy a put, then I can sell it? No, you don't have to buy a put before you can sell it. You can just sell a put now. Like when the market is open, you can just go and sell a put. Sell a put. You're basically selling an options contract, and you can do it anytime. Okay? So you don't need to buy a put to sell a put. You can just sell a put first. All right? Then another common question people ask is, Adam, must I first own 100 shares? Then I can buy a put on the 100 shares. No, you don't need to own any shares. You don't need to own any shares. You can buy a put now without having any shares. You can also sell a put without having any shares, okay? To answer that common question. So let's look at this thing again. Now, if you buy a put, you pay what? You pay a premium, right? You buy insurance, you pay premium. Who collects the premium? Who collects the premium? The put seller collects the premium. This is the insurance company. They collect your fire insurance, okay? Now, the person who buys the put, once he buys the put, he has the right to sell 100 shares of the stock to the put seller at the agreed upon strike price, which in this example is again 190. All right. So for the put buyer, he's hoping that the stock price will go down. Remember, when the stock price go down, the put is worth more, and he can sell the put for a profit, right? Let me pause here for a few seconds to let you digest. So far, do the rest of you get this part on the left? Okay. Now, let's look at the put seller now. Now, for the put seller, they sell the put. Why do they want to sell the put? Why do they want to sell the put? Because he wants to get the premium, okay? But by selling the put, now the put seller is obligated. He's obligated to buy the 100 shares from the put buyer at the strike price, which is 190. Okay? So for the put seller, in a way, the put seller is hoping that the stock price will not drop. If the stock price doesn't drop, the stock price goes up, or the stock price goes sideways, what happens to the put? If the stock price goes up or the stock price goes sideways, what happens to the put? The put will lose value, and then the put will become worthless. When the put becomes worthless, the put seller goes, yes, it's worthless, yay! I'm no longer obligated to buy the shares, but I keep the premium, right? It's like the insurance company sell you car insurance. He hopes that you don't get into an accident, right? And every year, you have to pay the car insurance. They just get premium, right? Of course, one day when you get a car accident, then they have to pay you to repair your car. But in the long run, they make more collecting the premium than paying you to repair your car. Same concept here, okay? So what happens if the stock price drops? You may say, what if the stock price drop? If the stock price drop, then the put seller is obligated to buy the shares at the strike price. So let's say the stock price drops to 180. or 150, then the put seller is obligated to buy the shares at 190. Now, is that risky? Is it risky that as the put seller, you have to buy the shares at 190? Is it risky, yes or no? The answer is it depends on what kind of stock. If you have to buy stock of a speculative stock, or a company that's not making money, or the company that's very risky, then of course it's risky, right? But if you are obligated to buy shares of McDonald's, of Pepsi, of Apple, of Microsoft, which are the very, very safe companies, which I talked about yesterday, where I only want to buy the top 1% of companies in the world where every year they make more and more money. These companies are very safe. To me, there's no risk. To me, there's no risk, because even if the share price drops temporarily and I have to buy the shares, I don't care, because I know later it's going to bounce back up. Right? You understand the concept here? So in the market, I am playing the role of the insurance company. I'm selling insurance every day. Okay, you see, a lot of people in the market, they are very nervous. They are very nervous. They read all the doom and gloom news. They think, oh, market's going to crash, it's not going to crash. So a lot of people, what do? They keep buying insurance to protect their stocks, right? Now, I'm the opposite. I'm the guy selling the insurance every day to all these scaredy cats. I sell them the insurance, right? And I keep collecting premium, okay? But I'm very smart. Thank you, right? I only sell insurance on very, very, very safe companies that even if the price drops temporarily, I know it'll bounce back later because the company itself is very, very good. You understand? So if I can give you an analogy, it's like I'm selling car insurance every day, but I sell insurance to very safe drivers who are above 40 years old, who drive at 50 kilometers per hour, who drive Volvo with double airbag and put on seatbelt everywhere. Very safe. All right. I don't sell insurance to people who drive recklessly, who are 20 years old, they watch Tokyo Drift, they watch Fast and Furious. I don't want to sell insurance to those people because they will crash very regularly. I sell to people who drive safely, very rarely crash. Even if they crash, they are safe because they got seatbelt and the car is reinforced steel. You understand? You understand my analogy here? Very good. If you understand this, you got it. This is how Limpe make money, okay? I am an insurance agent. So very often when people say, Adam, what's your job? I say, actually, I'm an insurance agent. Sell insurance every day in the market, yeah? Okay. So now let me actually tell you the step-by-step of how I do it. Let's go down to the actual strategy. You guys ready? Okay. So the first strategy that I use almost every day, which is the strategy used by Warren Buffett, is I sell cash secured puts. I sell cash secured puts. And by selling cash secured puts, I get paid every month. I get paid free premium every month, waiting for the shares to drop to my intended buy level, right? So first of all, let me tell you, when do you use this strategy? Okay, you only use this strategy when you want to buy 100 shares of a very good company. That means you already know this is a very good company. It's the top 1% of company in the world. It is undervalued, and I don't mind buying 100 shares of this company. Okay, so it must be a very good company. Don't do this on companies that are very risky, like Tesla. To me is too risky. I'll never dare to do it on Tesla, or like C Limited, or even like, you know, anything that's risky. I don't dare. You know, do it on very, very safe companies. Okay, yeah, Meta, I'll dare to do it. Yeah, okay, because Meta to me is very, very safe, right? So number one, identify a fundamentally good company that you want to own or you don't mind owning, right? So a good example recently, which I did it, is Pepsi. Pepsi is a very safe company, super safe company, right? Now, I only do it when the price has dropped significantly. Okay, I want to wait for the time when the share price drop to undervalued levels and it has hit a certain support level, or I see a certain bullish candlestick pattern telling me that the price is starting to rebound back. Okay, so this is an actual trade I did, which I shared with my students, and I'll show you the actual trade in a short while. So what happened to Pepsi? You can see that Pepsi had a big drop here, right? Right? And Pepsi dropped. Now, what's the intrinsic value of Pepsi? The intrinsic value I calculated is $188. So when it goes undervalued, I know that even if I have to buy the shares, I'm getting a very good deal. I don't mind buying it undervalued because I know it's a good company. You'll go up quite fast, right? Okay. Now, I wait for it to drop. And now, for those of you, if you attended Elson's price manipulation session yesterday, you know that when you have a 90-degree drop and you get this bullish pin bar, this is a sign that it will going to reverse, right? We call this a bullish pin bar, and we call this I call it a parabolic drop. Elson calls it a flush down, okay? So when I see that the price is going to start reversing, I will sell a put, okay? So let me show you again how I did it. Now, on this day, 10th of October, Pepsi starting to go up already, right? It already bottomed, starting to go up, and the share price was at 164. At 164, okay? Now, actually, could I have bought the stock at 164? If I wanted to, could I buy at 164? It's a good company, it's undervalued. Could I buy at 164? Yes, I could, right? I could do it if I wanted to. But I wanted to play hard to get. I said, you know what? I only want to buy the stock at 155, which is super undervalued. Okay, I want to buy at 155. Now, if I want to buy the stock at 155, what could I do? I could simply wait for it to drop back to 155 and buy it. Or I could put a buy limit order and hope that it will drop to 155, right? But if the price doesn't drop to 155, if it keeps going up or go sideways, I won't get to buy the shares, correct? So instead of waiting like an idiot for it to drop to 155, might as well I get paid to wait for it to drop. So what I did was I sold a put option at 155 strike price. Now, why did I sell a put option at 155 strike price? Because by selling the put option, I collect a premium. And the premium on that day was $3 premium. Okay? Now, times 100 shares, that's $300 of free money I get. I get free money, $300 of free money. Okay? Now, if you think of this, I collect $3 premium, right? And I'm obligated to buy the shares at 155. What's 3 divided by 155? That is roughly about 2% of free money I get in 37 days, which is about 1 month of free money. Okay? Now, 2% a month, how much is that a year? If I get 2% a month, a year, that's 24% return. Can you see what I'm saying? So is that pretty lucrative? 24% return a year is very lucrative just by selling these cash secured puts. All right? Now, again, by selling this put here, I collect $3 premium, but I'm obligated I'm now obligated to buy 100 shares of Pepsi at 155. Which, if that really happens, I don't mind doing it because Pepsi is very good company and to buy at 155 is damn bloody cheap. You follow me? So I'm being paid $3 to wait for the stock to drop to 155 so I can buy it. Okay? Now, what are the different scenarios? Let's look at the different scenarios here. Oh, by the way, this was the actual notification alert I gave to my subscribers. Yeah, if you subscribe to the UIP, you get all my notifications. Whenever I buy and sell a stock, every option trade, you are notified within 5 minutes, every single day. All right. So on the 10th of October, you can see I send this alert to my subscribers. I sold a cash secured put on Pepsi at 155 strike price, 17 November expiry. I collect $3 premium per share. And this is a screenshot of my trade from my broker. Okay. Okay. Megan is asking, can I show this screen for a while? Yeah. Okay. Here's the screen over there. Okay. Okay. Now, let me go through the different scenarios now. Okay. Let's look at the different scenarios. So again, let's look at this table to understand. So when I sold the put, Pepsi was at 164 here. Okay, Pepsi was at 164. I sold the put option at 155 strike price and collected a $300 premium. All right. So by collecting a premium, I'm obligated to buy 100 shares at 155. Okay. Now, let's say scenario number one is that the Pepsi shares don't go to 155. That means the price goes up or the price goes sideways or the price goes down but doesn't go to 155. Okay? Or it could even go below 155 but bounce back up before the expiration. So these are all the different scenarios. That means by expiration, it stays above 155. So if Pepsi stays above 155 by the expiration date, what happens? What happens? The put that I sold will become worthless. And then I just keep that free money. And then I just repeat the same process every month and get 2%, 2%, 2%, 2%. Right? That's how I made hundreds of thousands every year doing this simple shit. Okay? The only thing is that I must be prepared to buy the 100 shares at 155 if I really have to. That's the only thing. You need to have the cash to buy that. That's why we call it a cash secured put. Okay? Now, scenario number two. Okay? Scenario number two is the price goes down and drops below 155. Drops below 155 and stays there by the expiration. So if it expires below 155, what happened? By the expiration date, the put option will be exercised and I will be obligated to buy the 100 shares. Okay? I'll be obligated to buy the 100 shares at 155. Now remember, I already collected the $3 upfront. When you sell the put, you collect the premium upfront. So I have to buy the shares at 155, but I already collected $3. So my net purchase share cost will be 155 minus 3, which is 152. Now, if I get to buy Pepsi at 152, is it a very good deal? If I get to buy Pepsi at 152, is it a very good deal? Yes, it's a bloody good deal, right? So can you see that it's a win-win situation? I cannot lose. I cannot lose in this method. If the price goes up, I get free money. The price goes down, I get the shares at a big discount. I can't lose. I cannot lose as long as I do it on a very, very good company that's the top 1% of companies in the market. Okay? Now, let me share with you another thing. What if the price drops below 155 and is going to expire, and I'll be obligated to buy the 100 shares. But at the last minute, I decide, I don't want the shares, I don't want the shares, I don't want the baby. Can I get an abortion? Okay, don't say that, very bad. Okay, but if at the last minute, I don't want the shares, what could I do? Okay, if I change my mind, I don't want to buy the shares, no problem. I just buy back the put that I sold. Okay, so I buy back the put option which I sold, but I'll lose money on the put option because I sold the put. Now I have to buy it back at a higher price. I will lose money on the put option, but simultaneously, I will sell another put option with a further expiration date, with a lower strike price, and collect new premium to offset the loss of the old put. Right? So we call this rolling the put down. And I do this all the time. So many times I decide I don't want the shares, I buy the put back, I sell another put, repeat, roll until eventually expires. I don't lose anything. Okay. Now, I'm just saying from my personal experience, I have never lost money on this. I have never lost money on this, even in the 2020 bear market. When I did that, you know, the bear market collapsed 30%, I still made money by the end of the year. All right. 2022 bear market last year, I still made a few $100,000. Why? Because I do this on very, very safe companies. And if I don't want the shares at the last minute, I don't want the baby, I roll until the price bounces back. Okay? So that is what I do. Okay? So you can see these are all my option trades that I notify my subscribers. This, you can see almost every day, right? So 1st of November, can you see I close this covered call, okay, this covered call, 87% of max profit. I close my Visa put at 85% max profit. I close my Pepsi, then I closed it in 22 days at 90% of max profit. So I don't always let the option expire. If I feel that I already got 90% of the profit, I will close it early, right? I close triple Q, credit spread at 95% of max profit, close ADP at 85% of max profit, close into at 90% of max profit, right? This is what I do every day. Okay, now currently, let me show you my open positions. I don't have many open positions because I've just closed and taken profit on most of them, right? But I'll show you my account right here. Okay, there we are. So this is one of my accounts. I've got a second account over here. I've got two accounts over here. You see? So let me show you, right? So can you see this Viva December put option? Can you see? So I sold this put option and collected $6.45 premium. Can you see? Right? And since I sold the put option has dropped in value to $3, which is good because I want it to drop to zero, right? So it dropped by half. I already make $668 profit. Can you see? Then Thermo Fisher, right? I sold it at $65, dropped to $44. I already made $2,000. Okay. McDonald's, I sold the put at $4.34, dropped to $178. I made $500. Low, I sold the put at $4.94, dropped at $194. I make $599. All right. So these are my current open positions. And this is the TLT bullish synthetic, which is another strategy. I'm up 4,004 on that one. Okay. And I do the exact same thing on my second account. It's actually the same trades here. Okay. So these are the way I trade options. Okay. So do you want to see a new example now? Okay, so let me show you a new example now. And this example would be on Dollar General. Okay. Now, Dollar General is quite a good company as well. All right, and it dropped quite a bit significantly recently, and I may sell a put on it on Monday. All right, I'm still deciding. Now, take a look at this. Dollar General, if you calculate the intrinsic value, is 134. Okay, that's the intrinsic value I calculated. Right now, it dropped to 121. So currently, it is already undervalued. Okay, and you can see in a way that the price has begun to bottom, right? You can see it was on a downtrend, but now it's beginning to go sideways and it's above the 50 moving average. So there's a good chance it will go sideways or start to rebound up. Okay, so if you think that this is a good company and it's really bottom already, it's going to start to go up, you could buy the shares if you want to, or if you want to get free premium, you can just sell a put. Okay, so let me give you an example how I would sell a put option on this guy. Okay, so what I do is first I go to trade. Can you see go trade here? Okay, and when you go to trade, you can select whichever date to expiration you want. Now, for me, the sweet spot is to sell between 30 to 45 days. Okay, 30 to 45 days is a sweet spot. Someone asked me, how do I know if the premium is cheap or expensive? Okay, there's two ways to tell. Okay, first, we look at what we call the IV rank. The IV rank, the implied volatility rank. If the IV rank is above 35%, that usually means that the premiums are high, which means if you sell options, you get very good premium, right? So we want the IV rank to ideally be 35% or higher, okay? When you enroll into the options course, you will get all these IV rank indicators to tell you the IV rank, right? So this is 99%. Look at that, 99%. That means the options are very expensive. When you sell it, you get very good premium, right? So that's one way to tell, all right? Now, another way to tell is this. Okay, so never mind. Before that, let's decide what is the date to expiration. So again, 30 to 45 days is the sweet spot, okay? So I could choose this one, 22nd December expiration. Let me open it up. Okay. And then these are all the put options. Okay. These are all the put options. So which strike price should I choose? Which strike price should I choose? Right now, Dollar General is at 121. Okay. So which strike price do I choose? Okay. Usually I want to get, usually how I decide is this. I want to get a premium of at least 2% a month. Okay, at least 2% a month. So which one will give me at least 2% a month? Okay, let's see. How about this one? 107. Okay, if I sell this put option at 107, I will collect $2.12 premium. Okay, now is that at least 2%? Is that at least 2%? See, $2.12 that I collect premium out of the strike price of 107. Is that at least 2%? Close to 2%, right? 1.98, right? Correct, 2%. So I get at least 2%. You understand? So that is how I decide that I will sell at this strike price of 107. Understand? Okay. So I repeat, if I sell this put option at a strike price of 107, I will collect $2.12 premium. Let's see what it looks like on the charts. Okay. So 107 is somewhere here roughly. Okay. Let me make it a bit bigger for you so you can see. Okay. Okay. So right now the current price is 121. Okay. So I sell the put at 107 strike price. Okay. So, and this option will expire in how many days? Is it 35 days? About 35 days, right? So in the next 35 days, if the price goes up, the price goes sideways, or even the price goes down, but it doesn't go below 107, what happens? Then I don't buy any shares. I will just collect the free premium. Okay. But if the price drops below 107 and stays there, then I will be obligated to buy the shares at 107. But remember, I buy the shares at 107, I already collect $2 in premium, which means my actual purchase price will be 105. And if I can buy Dollar General at 105, when the intrinsic value is 134, I'm getting a very big discount, which I don't mind to buy as well. You follow, everyone? And like I said, at the last minute, if I decide I don't want the shares, I don't want the shares, I don't want the baby, what can I do? I buy the put back, sell another put, roll until it expires eventually. All right. So to me, in my opinion, to me, it's like a win-win situation, right? Yeah, earnings is coming, it doesn't matter, right? I do this even if earnings are coming. Yeah, I don't worry about earnings for this, right? Because even if the earnings come and it drops below, I will just buy it at a very good price. Okay, so it doesn't matter to me that earnings are coming. Okay, do you follow so far, everyone? Is this interesting? Okay, now, some of you, oh, by the way, just to share, this is one of my very beloved students, all right, Olivia, okay? And the reason she's a very beloved student is because she's so participative in the chat groups, and she always shares all her results and all that, and very, very inspiring to other students. And Olivia is someone who attended my course, I think now about, is it 3 or 4 years ago? And what's amazing is before she attended my course, she was extremely conservative. She was so conservative that she did not even dare to buy stocks. She put all her money into fixed deposit. That's it, right? So it was quite amazing that when she took my investment course, she started for the first time in her life 4 years ago to start buying stocks. And then she took the options course, right? And then in less than 1 year, she became one of our top options traders. And this is someone who put all her money in fixed deposit, right? And she shared every single month, right, all the premium that she gets selling cash secured puts as well as covered calls. And, you know, she makes money almost every single month. In fact, every month. In her worst month, she made like $100, right? In her high month, she made $7,000 to $8,000, right? This is Rashid, right? He said, we are all grateful to be part of this community. Adam and Bang have given us lifetime tools to achieve our financial goals. We are forever indebted to you. Whatever we say here will not do justice to the impact you had on our lives, right? He said, my 1 year return starting June, 47% return, purely investing with covered call and cash secured put to turbocharge my portfolio, all right? Now, what's the catch? Now, so this first strategy that I showed you, like I said, to me, is the best strategy in options, right? But the catch is that you need to have the cash ready to buy 100 shares. Okay? You need to have the cash ready to buy 100 shares if you need to buy the 100 shares. Now, some of you would say, but Adam, I don't have the money to buy 100 shares, right? I've got a very small account. I only have $3,000 in my account. I only have 5,000. So I can't do that, right? So no worries. If you have a small account and you're not able to buy 100 shares, then there's another strategy that you can use. Ready? So this strategy is good for people with small account. And even if you've got big account, you can also do this. Okay? So this strategy is called bull put spread. All right? Bull put spread strategy. Bull put spread strategy is also known as a credit spread strategy. Why is it called credit spread? Because when you enter the trade, you are paid money upfront. You get a credit upfront. That's why we call it a credit spread. Okay. Now, this is one of my favorite ways to trade stocks. Instead of buying the stock, I like to sell a bull put spread because it has got a much higher win rate. So let me explain how this is done. Okay. So again, let me go step by step. So first of all, you only want to do this strategy on big companies, on large companies that are at least $10 billion in market cap. So I only do this on S&P 500 companies. Don't do this on small companies. Do this only on very big companies that are stable. Okay? Now, the next thing is, if you are a beginner, it's safer to do it when the stock is on an uptrend. It's on an uptrend. Now you may say, how do I know it's an uptrend? So there are two ways to tell. Number one, look at the moving averages. Can you see these colorful lines? Those are called the moving averages. Now, a very simple rule is this. This red dotted line is called the 20 exponential moving average. The blue dotted line is the 40 exponential moving average. Okay, so this is the 20 and 40 exponential moving average. Now, remember, when the 20 is above the 40, that means the short-term trend is up. That means it's a short-term uptrend. Okay. Okay. Now, then next, this thick blue line here, this is the 50 moving average. And this green line is the 150 moving average. And this red line is the 200 moving average. When the 20 is above the 40, that means the short-term trend is up. When the 50 is above the 150, that means the medium-term trend is up. When the price is above the 200 and the 200 is sloping up, that means the long-term trend is up. So the strongest uptrend is when the 20 is above the 40 and the 50 is above the 150. Okay, so that is when the trend is the strongest. Okay, so if you're a beginner, then it's best to do this on a very strong uptrend. Okay, now the other thing is, notice on an uptrend, the price move in wave patterns. Can you see? Wave up, wave down, wave up, wave down, wave up, wave down. Can you see this wave pattern here? Okay, so what happens is this. First, I make sure it's on an uptrend. Okay, next, I wait for a wave down to a strong support and is going to bounce up. So right here, can you see after it's an uptrend, after it waved down, it is starting to going to what? It's going to what? It looks like it's going to bounce up on the uptrend, right? Okay. So at this point of time, what do? Roberto, the 50, 150, 200 are simple moving averages, not exponential, simple. Only the 20, 40 are exponential, right? Okay, let me get back to this, right? So I repeat, when I think the price has hit a strong support and is going to bounce up, what do? This is on daily candles, right? What I do is I will then sell a put option below the market price. So I sell an out of the money put option here. Now, again, why do I sell a put option? Why? Why do I sell a put option? Because when I sell a put option, I collect what? I collect what? Premium, right? I collect premium. Okay? But by selling the put option, I'm obligated to buy the 100 shares if the price drops down, right? But if I don't want to buy the 100 shares, I don't have the money to buy the 100 shares, then I need to protect this put by buying another put at a lower price. I have to buy a further out of the money put in order order to hedge the first put. And these two puts must be having the same expiration date. Okay? Now, again, why do I do this? Let me explain. Remember, when I sell a put, I'm obligated to buy 100 shares, correct? If the price drops. But if I buy a put here, then I have the right to sell 100 shares. So can you see that this cancels it out? You hedge. I have to buy 100 shares, but here I can sell 100 shares, cancel out. So we call this hedging. You understand? Another way to think of it is I sell insurance here. I sell insurance, but I buy reinsurance to protect myself. So my risk is limited. Okay? So we call this a bull put spread. Now, when I sell this put, I collect money, right? I collect premium. I collect money. But when I buy this put, must I pay money? When I buy the put, must I pay money? Yes, I have to pay money, right? But I collect more, I pay less, net, I receive money. So we call it a credit spread. So net, I receive money. All right? Okay, so understand the concept? Yes, there will be a replay. Don't worry. There will be a limited time replay that you can watch this again. Yeah. So far, can you guys follow? What's the catch? There's a catch. Of course, there's a catch. I'll be going through the catch in a while. Okay. So let me go through the strategy one more time. So first, again, we only want to do this on large companies that are in the S&P 500 that have a market cap of at least $10 billion. And we want to only do this when volatility is high. When the IV rank, ideally is above 35%. Okay? So again, what's the strategy? Strategy is, if you're a beginner, make sure it's on an uptrend and watch the wave pattern. Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, boom. Once it hit the support level, you anticipate, you anticipate the price is going to go up, right? Okay, you anticipate it's going to go up, then you sell the put here, and then buy another put here. Okay, so you sell a put below the market price. Let me say, how far below do I sell? Okay, so later I'm going to show you, we will sell this put at a delta of 25. What is delta? Okay, I'll show you later what is delta, right? But basically, a 25 delta means that there's only a 25% chance, that the price will drop and stay below this put. Only 25% chance. That means there's over a 70% chance, there's a 70% chance that the price will not go below this level. That's why we've got a 70% win rate. So this win rate is not something that I made up or pull it out of my ass, all right? This is mathematically a mathematical fact. There's a 70% chance it will stay there and not drop below this. Now, some of you will be thinking, Adam, if it's on an uptrend and you think the price will go up, right? Why don't you just buy a call option? Or why don't you just buy the stock, right? If you buy the stock, buy the call option, it go up. Easy. Why you want to do this sell put, buy put, so complicated, right? Okay, so the answer is very simple. Remember, if you buy a call option or you buy the stock, you only make money if it goes up. You only make money if it goes up. But how many of you, many times after you buy the stock or you buy the call option, it doesn't go up very fast. It goes sideways, or even goes down. How many of you that happened to you? And then you don't make money, right? So the good thing about this strategy is I don't need the price to go up to make money. I no longer have to be right on the direction. If the price go up, I make money. Price goes sideways, I make money. Price go down, I also make money. I make money in all directions, as long as it doesn't go below this level. So I've got a very wide profit zone, right? And the statistical probability of the price staying here is 70%. So this gives me a much higher win rate than just buying a call option or buying a stock. Understand? And again, the sweet spot is I will sell a put and buy another put at between 30 to 45 days expiration. Okay, so do you want to see a real life example? Want to see a real life example? Okay, so let's look at a real life example on VRTX. Okay, so let me open up my trading tab. Okay, VRTX. Let's look at this stock for VRTX. VRTX. And let me just put in my studies. Okay, there we are. So first of all, if you look at the stock, is it on an uptrend? Is it on an uptrend? Yes, the 20 is above the 40, the 50 is above the 150, and above the 200. So it's still on an uptrend, right? And can you see the wave patterns? Wave up, wave down, wave up, wave down, wave up, wave down. And you can see what happened last week was that it dropped and it is now at a what? What's this called? What's this called? What is this called? A support line, right? So we always want to make sure that the price drop to a support so that there's a good chance that it will what? Bounce off the support, right? And you can see it made a bullish candlestick pattern on Friday. We call it a bullish ice cream bar, right? So there's a pretty good chance, of course, there's no guarantee, right? But it's a pretty good chance that it hit the support is going to bounce up or at least maybe go sideways, right? So this is a time I could sell a bull put spread. Now, what is the IV rank? The IV rank is 57%. Can you see? Which means it's more than 35%, which means the option premium is very high and it's a great time to earn premium. Yeah. Okay. So now I have to decide where to sell the put and where to buy another put, right? Okay. So how to decide? So first, go to my trade tab here. And I have to choose the date to expiration. Again, what is the sweet spot? What's the sweet spot? 30 to 45 days, right? Okay, so let's say I choose this one, this option expiring on 22nd December in 34 days. Let me try this. Open it up. And I look at the put options here. So the question is, which strike price do I choose? Which one do I choose? So I always look at delta. Always look at delta. Look at delta, okay? So for this strategy, I want to sell the put at a delta of 25 or lower. 25 or lower, okay? So can I find a 25 or lower? 27, 21. 27 is a bit high. I prefer 21, right? So can I choose this one? Can I choose this one? Okay, so I'm going to sell the 330 put. Okay, hold on, let me do that again. Let me draw again for you. Okay, so this one, 21 delta is less than 25, right? But you want 25 or less, okay? So I'm going to sell this put here. Let me write this down. I'm going to sell the 330 put. Sell the 330 put, okay? Now, if I sell this put, how much money do I get? I collect $3.77. Can you see? I collect $3.77. Okay. Now, after I sell the put, I need to buy another put, right? Sell insurance, buy reinsurance. So to keep it simple, I want to buy a put $5 below that put. So what is $5 below? 325, right? So I will buy the 325. Can you see? So if I buy the 325, I have to pay $2.25. So I repeat, I sell this put, I collect 377. I buy this put, I have to pay 225. So net, how much money do I make? 377 minus 225. Net, I make 152. I make 152 credit. So that's why we call it a credit spread. Can you follow so far? Okay. So let's go back to the charts and see what this looks like. No, it doesn't need to be below intrinsic value for this one. All right. Okay. So if you look at the chart there, can you see 330 here and 325? Okay. So I'm going to sell, watch here. I'm going to sell the put at 330 strike price, and I'm going to buy a put. Oh shit, hold on. Okay, and I'm going to buy a put at 325, right? So I'm going to collect money here. I'm going to pay money here. Net, I will collect $1.52 credit. Okay. So do I have a good profit zone? Do I have a good profit zone? Stock price go up, I make money. Stock price go sideways, I also make money. Stock price drop, I also make money. As long as it doesn't go below 330, I will win. So I will have by the way, what's my win rate here? What do you think is my win rate? Remember, I sell the put at 21 delta, right? That means there's only a 21% chance the price will drop below this level and stay there. So my win rate is way above 70%. In fact, it's about more than 75% win rate. Okay, so let me show you how I set up the trade right now. So let's go to the trade tab here. Okay. So what I do is I will go to 330 and sell this. Okay. So when I want to sell an option, I click on bid. When I want to buy an option, I click on ask. Okay. So I'm going to sell this, click on bid. Okay. And then I will buy 325, press the control key, and then click on here. Okay. There we are, brothers and sisters. Okay. So over here, you can see that I sell one contract at 330 strike, buy one contract at 325 strike. Net, I collect $1.52 credit. Now, one contract is 100 shares, right? So $1.52 times 100 is $152 I collect upfront for a credit spread. By the way, let me just tell you this. What I'm showing you here is based on the current price on Friday. Okay. On Monday, when the market opens, the price will change. It may be very different. So please don't blindly on Monday go and do this, because the price could be very different. That's why when the market opens, I have to recheck to make sure I get the same numbers or better numbers to enter the trade. All right, so please be aware of that. Also be aware that this broker I'm using is called Think or Swim. Now, in the options course, I'll show you how to use the Think or Swim broker as well as the interactive broker, because I use both. I trade using two brokers. So this is using one broker, but in the course itself, you will see how we execute using multiple brokers. So because each broker, the platform is a bit different, right? So don't worry if you don't have this platform, you will also learn how to do it on other platforms as well. It's more or less the same, okay? Now, watch this. Once I click confirm and send, I will get this confirmation box, okay? Now, what is my profit from the trade? My profit from the trade is $152. Can you see? That is the premium I collect upfront, 152. Now, some of you would say, hey, Adam, I see my maximum loss. My maximum loss is 348. That means I can lose more than I earn. I earn $1, I can lose more than, I can lose like $4. Adam, are you crazy? Right? Don't worry. Okay. In reality, will I lose 348? No. Because I've got certain exit rules that once the price drops to the strike price, I will close the trade to cut loss, and the loss is much smaller than this. But could you actually lose 348? Could you actually lose 348? Yes, you can if you don't manage the trade properly. That means if you let the price drop below the strike price and you let it expire, yes, you can lose 348. Let me warn you. So this is a trade that you have to monitor. You cannot do it and then forget about it. And then the price drop, you lose 348. Huh? Okay? So if you ever lose the maximum loss, please give yourself one tight slap on the face because you never follow the rules. Okay? Now, can you see this thing called buying power effect? So it tells you when you enter the trade, the broker will use $349 of your capital to enter the trade. All right, $349 of your capital is used in the trade. So in other words, you make a profit of 152 out of 349 capital. What is your return on capital? What is your return on capital? Your return on capital is 43% return on capital in 35 days. Okay? Now, one rule I must tell you, very important. When you do this bull-put spread, you must always make sure that your buying power, by the way, the buying power and the maximum loss is the same, right? It's basically the same, right? It's almost the same, right? Always make sure that your maximum loss cannot be more than 4 times of the maximum profit. I repeat, the maximum loss cannot be more than 4 times of the maximum profit. So in this case, what is 348 divided by 152? 348 divided by 152 is 2.28. Correct? Is it below 4? Yes. So it must be 4 or less. More than 4 is not a valid trade. Okay. Now, again, I know there's a lot to remember. That's why please take the options course where we go through in detail, step by step, with a lot of examples. And you really understand how this works. Please do not trade it just after this introductory webinar, okay? Because as much as I want to teach you everything, it's impossible because there's a lot more to cover. I can only give you the general idea. But ultimately, in the course itself, there's still another 50% of details that you need to know. Okay, but this gives you the general idea. Okay. Now, let's take a look at the profit and loss of this trade. So I'm going to open up this profit and loss analyze tab here. And let me just explain how this works. So over here, this is the profit and loss of this particular trade. Okay, let me orientate you how to read this. Are you still following me, everyone? Just to make sure you guys are still following me. Okay. First, let's look at the y-axis. On the y-axis, this is the 0. Above this is profit. This is loss. Okay, so this is the profit, this is the loss. Now on the x-axis, horizontal, is the stock price. So right now, what is the stock price? Right now, the stock price is $350. Right, this is the current stock price. Now the stock price can go up in the next 35 days, or the stock price can drop in the next 35 days, right? Okay. Now, can you see this green line here? Can you see this green line? This green line tells you your profit and loss on the day of expiration. When does the options expire? It expires on the 22nd of December in 35 days, right? Okay. So on the day of expiration, this green line will be your profit and loss. Now, can you see where is your profit zone? Where is your profit zone? Your profit zone is here, right? So the stock price goes up, you make money, maximum profit. Stock price drop, you also make money. Now, you only lose money if the price drops to here. This is where we will cut loss at 330. Okay, this is the danger price. Can you see 330, which is the strike price of the put? Okay, so if the price drops here, I will close to cut loss. Okay, but if the price remains above 330, I will get the maximum profit here. Understand? So I've got this is my profit zone. I've got a very wide profit zone. Now, look at the probability. Can you see? My chance of losing is, in this example, 25% chance of losing. And my chance of winning is 75% chance of winning. This is mathematically calculated. It's mathematically calculated by the computer. Okay? Okay, so now let's say, now what is the purple line? Some of you are asking. The purple line is the profit and loss today. Okay, so if you enter the trade tomorrow is the 20th of November, right? Okay, can you see here 20th of November? Okay, now if you enter the trade tomorrow, and let's say you're very unlucky, right? The moment you enter the trade, the price drops. From 350, the price dropped to 330. And it hit 330, what must you do? What must you do? You must cut loss. You must close the trade. Now, if you close the trade, how much do you lose? How much do you lose? You will lose the purple line. Can you see the purple line? That is how much you will lose. Now, if I put my mouse here, look at the box, look at the loss in purple. What is the loss? What's the loss in purple? Minus 148. Can you see? Okay, so let me write this down for you. Okay, if it drops here, I will lose $148. Okay, now if the price doesn't drop, what's my maximum profit? My maximum profit is 152, right? Okay, so I'm risking 148, okay, to make 152. That's not a bad risk to reward, given that I have got a 75% chance of being right. Okay. Now, I have to warn you that in this strategy, sometimes when you cut loss, you can lose up to 1.5 times your credit. That means if you collect $100 here, you could lose 150 here, okay, in some scenarios. But in this scenario, it's very good because I collect 152, I only lose 148, which is less than this, right? Now, notice what happens as time passes. After you enter the trade, this is 20th of November, right? Now, what happens on the 21st of November? When I click 21st, 22nd, 23rd. Now, look, as time passes, what happens to the purple line? Can you see what happens to the purple line as time passes and it goes to expiration? What happens to the purple line? Can you see now? What happens to the purple line? The purple line will move towards the what? Green line. Can you see? So by the time it reaches the expiration date, you will hit the maximum profit. Okay? And if the stock price drops later, you actually lose less or just break even. So what is great about this trade is that as time passes, your risk is lower and lower. So even if the stock price drops to here, you still break even. Okay? Now again, I'm doing my best to teach you this in this very short period of time. You know, in the actual course itself, there's a lot more time spent on the details. But, you know, I just want to make sure you understand the main concept today. Yeah. So far, you guys get the main concept at least? Okay, great. Now, the one thing you must understand about trading, whatever trading, forex trading, stock trading, options trading, can you win all the time? In trading, can you win all the time? It is impossible. You will have winning trades, you will have losing trades. There's no such thing as you cannot lose. The same thing as a casino. When you open a casino and people play in your casino, will there be times that the players will win? Will there be times when the casino will also lose? Of course. But over time, as the players play and play and play, the casino knows that they will win more than they lose because of the house edge. And at the end of the day, the players always lose in the end, and the casino always win because the house has a statistical edge on the player. Understand? So that's the same way you must think about options trading. You are the casino, you are the house. There'll be times the player will win. There'll be the time you win. But over time, if you stick to the rules, you will always win money from the player. The player will always lose in the end. And who are the players? The players are all the other traders who never learn options properly. Okay, you will take all their money in the end. All right, that is the whole thing. Okay, so let's say you do 100 trades. You take 100 trades and you have an average win rate of 70%. So that means to say you will have what? 70 wins and 30 losses. You never know when the loss will come. You never know when the win will come. It is random. Sometimes you could have a losing streak of 5 losses in a row. Sometimes you can have a winning streak of 10 wins in a row. You don't know. It is random. All right. Now, each time we win the credit that we receive. Let's call that C. Right? C stands for the credit we receive, which is $152 in the last example. Okay. And let's say that when you lose, when you cut loss, if the price drop to the strike price, you cut loss, you lose up to 1.5 times. Now again, will you always lose 1.5 times? No. Sometimes you will lose much less, like that example I showed you. And yes, sometimes you may even lose more. If the price gap down, it can happen. And that's why for this particular bull put spread, never hold the trade through the earnings. For cash secured put, you can hold through earnings. I hold through earnings because I can buy the shares. But in this case, for this strategy, never hold through earnings. You must always get out before the earnings are reported. And if the earnings are coming, never enter the trade before earnings are reported for this strategy. Okay? So just to warn you. Now, so if you do this, then when you lose 1.5 times your credit. When you 1 time your credit. So net, do you make money? Net, you make money. You make 25 credit, right? So this strategy has a positive statistical edge, like the casino has a statistical edge over the player. Now, let's put some numbers into it because I know it looks a bit abstract, right? Let's put in some numbers so you better understand here, okay? So let's say on average, every time you enter a trade, you target to collect $200 premium, okay? And if it's a losing trade, you lose what? Up to 1.5 times, right? Which is $300. So if you put in the numbers, you can see each time you lose 300. And each time you win 200. So net, you make $5,000. Okay. Now, what is the return on capital? Okay. So let's look at an example of money management. All right. Let's say you have a capital of $10,000 to start trading. Now, you don't want to use all your money. You must always have a buffer. Okay. So for me, I would normally use up to 70% of my money only. I'll only use up to 70% of my money, which means I will only use up to 7,000 buying power. Okay. Now, earlier, remember what I told you. For this strategy, make sure that your maximum loss, your buying power is not more than what? Your buying power is not more than what? Not more than 4 times your credit, right? Remember? Okay. So if you take 7,000 divide by 4, it gives you 1,750. So what does this mean? This means that with a $10,000 account, you should collect a maximum of $1,750 in premiums. But do you want to put it all in one trade? Do you want to go into one trade to get 1,750? No. You must diversify into many small trades. Pay attention. Never go into one big trade, because what if that's a losing trade? You never know when you'll be a losing trade. That's why for me, I always put very small trade. So even if this one lose, this one lose, this one lose, but my wins will cover my losses. Okay? So what I do is I want to make sure I divide into 10 small trades. So if I divide this by 10, that means each time when I enter a trade, I will just target to get $175 premium. And I can have 10 trades of 175 each. Okay. So remember the earlier trade I showed you? What was the credit? What was the credit we collected? 152, right? Yeah. So that is less than that, which is fine. Okay. So I'm just giving an example if you have got a $10,000 account, right? Okay. So if you do 10 trades a month, which is 120 trades a year, and assuming you get a 70% win rate, that means you will have 84 winning trades where you win 175. You have 36 losing trades, which is 30% of the time, where you lose 262.5. So you make 4,007, you lose 9,000 something. That's a net profit of 5,250. Okay. Now, what is 5,250 out of 10K? That's a 52% return a year. All right, which is okay, not too bad, reasonable for trading. Okay. Now, always remember that trading is like a business. In trading is like any business. So let me ask you this question, right? In any business, what do you have? You always have sales, revenue, minus what? In any business, whether you're selling food, you're selling clothes, sales minus what? Cost of goods sold equals your gross profit, right? And then you have to deduct your operating expenses, like your rental, your salary, all that stuff, correct? In any business, true? Okay. So remember, trading is like a business. So a lot of times when people trade and they lose money, they get upset. Oh, why I lost money? Why is it a losing trade? You cannot think that way. So to me, when I have a winning trade, it's like the sales revenue. Okay? It's like the sales revenue. When I have a losing trade, it's like my cost of doing business. As long as your win is more than your loss, you will make a profit. Do you understand, everyone? So when you think like that, you don't feel bad when you have a losing trade because you know it is part of the game. It's unrealistic to say, I want a business with only sales but no cost. There's no such thing. You got to have sales and costs to make a profit. All right? So that's how I train myself psychologically in trading. That we're going to have wins, we're going to have loss, but we'll always make money in the end as long as we win more than we lose. And the great thing about trading as a business is you don't have operating expenses. You don't have to pay for staff salary. There's no utilities. There's no inventory. It's a business you can do anywhere in the world. And like Singapore is tax-free. I'm not sure about the US, right? Follow, everyone? So why do I love this strategy, which is the cash secured put and the credit spread? Because why I love this strategy is it does not rely on me predicting the stock price direction accurately. So again, I don't need the stock price to go up to make money. If the stock price goes up, I make money. Goes sideways, I make money. Go down, I also make money. As long as it doesn't drop too much. If it drops too much, then of course it can be a losing trade for credit spread. Okay. Number two, it's mathematically proven to have a high win rate by choosing a low delta, right? And remember, statistically, 82% of options expire worthless. So if you sell options, the odds are in your favor. But if you buy options, the odds are against you, okay? And it requires minimum time commitment. 1 to 2 hours a day, that's it. It's one of the best jobs in the world, one of the best businesses in the world, right? Which business can you just work 1 to 2 hours a day, right? Again, can you trade options with a small account? Yeah, this is one of my students who shared. He said, this is my options trading account. It is a small account. I started with 2,000 in January and I added 12,000 in February. And from there, he built it up through his trading to 50,000. All investors need to understand options. It will help you to minimize risk and maximize return. If you don't understand options, it's like going to war with a knife and spear, right? And yeah, you can see his profit for the year, $40,000. Starting with a 2K and then top up to a 12K account. So yes, you can start even with a relatively small amount of capital. All right. And again, we've got so much of these testimonials over the years. I'm not going to run through all of them because I think I'm running out of time. And Bang Pham Van will be coming on soon to teach his new strategy, which I'm also using. And it's made me a lot of money. So I'd like to thank Bang for teaching me this new strategy called the Jade Lizard. Yeah, it's called the Jade Lizard. It's something that you don't want to miss. Remember to attend Bang Pham Van's lesson as well. All right. So by the way, Bang Pham Van, I call him the Yoda of options. I'm the Luke Skywalker. He's the Yoda, right? So together we run the options course. Now, if what you think you've learned today is interesting, is very lucrative, is very powerful, yes, it is, but it's only a small part. In the options course, you're gonna learn at least another 18 more powerful option strategies that again allow you to profit under different kinds of market conditions with any asset. So you don't just trade options on stocks. You can trade options on ETFs. You can trade options on futures, like oil futures, gold futures, silver futures, and you can trade options on Forex as well. All right. So whatever the scenario, example, if the market is very bullish, the market is going up, you can use a bullish synthetic strategy. Like for me, I think that the bonds are starting to rebound very strongly as interest rates go down, bonds. So recently I
am very bullish on the TLT, which is the bond ETF. And that's why you can see I entered a TLT synthetic strategy. I'm up 4,000 here. And over here, I'm up 3,006 on the synthetic strategy. So I use this bullish synthetic when I'm very bullish. When I think it's going up now, I use this bullish synthetic. All right. You can also use a bull call spread or a callback ratio. Now, if I'm moderately bullish, I think it will go up, but not very much. It will go sideways. I'm not sure. Then I use bull put spread. And in the course, you also learn the bull put spread extreme with an 80 to 90% win rate. That's even more powerful, right? And cash secured puts. Now, what if you're very bearish? You think the market's going to collapse tomorrow? Then you can use a bearish synthetic, a bear put spread, or put back ratio, right? So all these strategies are in the course. Every single one of these strategies are in the course, right? If you're moderately bearish, you think the market will go down slowly, use a bear call spread. If you think the market will go sideways, will go nowhere for 1 year, then use covered calls, use diagonal spreads, use calendar spreads, use iron condors. Everything is covered in the course. And if there's a special event that's going to happen, like the FOMC meeting, or companies going to announce earnings, or some thing's going to happen, right? You can use these earnings probability or sniper spread. So something for every occasion, all right? And again, we have got all these testimonials that I'm not going to run through because there are too many of them, but this guy's called Kok Liu. He's from Penang, and he's a orthopedic surgeon. And he's also one of our very, very successful option traders. And I think now he makes more money trading than his medical practice. Right? But we tell him, don't quit, right? Continue to save people's life, right? But he got 42% return in his trading, right? And we've got, again, so many of this that it's too many to mention, right? So again, I would say trading is the only skill that can guarantee you an income for the rest of your life. I've got people who tell me, Adam, I spent 50,000, 100,000, 200,000 on my bachelor's degree in the top universities. I've got my MBA, I've got my CFA, I've got all these qualifications. But they say, Adam, it can't guarantee me a career for the rest of my life because I can get replaced by someone younger, cheaper, and faster, and replaced by AI in the future. And many people have said, Adam, this course has the best educational value in my life. I spent 50, 100,000 on my MBA. I don't even know whether I can make the money back. But in your trading, investing option courses, when I invest that 3,000 or that 5,000, I make that back so fast. And I make back 10 times, 100 times. And it's a skill that I know for the rest of my life, I can use it to generate income for myself. No one can take away this skill from me. It's the best investment I made. Okay. So there are two option courses. We have got level 1, which is the iron shell course. Now, level 1, let me just double check this. Hold on, give me a second. I think I wrote it here. Okay, never mind. Forgot where I wrote it, right? So we've got level 1 course. Now, level 1 is 12 lessons. 12 lessons is about over 25 hours of training, right? So we have got lesson 1, basics of options trading. Lesson 2, how to set up the charts and trading tools. Again, I won't go through all the details because it's going to take too long, right? But there's a lot to cover to give you all the skills to become a proficient options trader. Lesson 3, you understand about long calls and puts. Lesson 4, how to generate extra income selling covered call options. Lesson 5, how to hedge your portfolio using protective puts during bear markets and market crashes. Lesson 6, how to sell cash secured puts. Lesson 7, how to buy vertical call spreads or bull call spreads. Lesson 8, how to buy vertical put spreads or bear put spreads. Lesson 9, cash flow wheel. Lesson 10, the basics of technical analysis. And lesson 11, how to build your options trading station. Sorry, my bad, it's not 12 lessons, it's 11 lessons for level 1, right? And over 20 plus hours of training. By the way, again, all these lessons, they are on-demand lessons, which means you can watch it anytime, anywhere, and you will get a lifetime access to all the videos, no expiry date. And we regularly update the content and add new strategies all the time. And there's no extra fee, there's no extra charge. So it's a one-time fee for a lifetime of new content and strategies, right? So it's a wonderful value that you're getting. Now, level 2, which is the Iron Strikers course, is where you learn an additional 18 profitable strategies. So this is where you learn about credit spreads, like the bull put spread, the bear call spread. You learn about iron condor, earnings probability spread, all those strategies that I talked about earlier on, right? Diagonal spread, calendar spread, all used for different occasions. Synthetic long and short stocks. This is the method I use for TLT, all right? You've got protective bullish synthetic, which is called the bull bang strategy. Many of these strategies you can't find anywhere else. Why? Because they were developed and invented by Bang Fan Ban, which is our chief options tactician. Okay, you will learn the Snipex, again invented by Bang Fan Ban, and a lot of psychology and risk management training as well, part of the options course. Okay. He said, "Happy Thanksgiving, Master Adam. I'm writing to express my heartfelt gratitude for being the most influential teacher, mentor, and advisor in investing and trading. This month, I continue to generate sweet profits, 150,000 in trading, all from options. My trading account shows 90,000 profits, 60K in another account, like cash secured put, bull put spread extreme. You have changed my life since I joined your classes. Thank you very much." Right? How to build a profitable options trading business, right? And a summary of when to use each strategy. Now, must you master all the strategies? No, you don't need to. In fact, all you need is 1, 2, or 3, and you do very well, right? But you are given so many to pick to decide, which are your favorites, right? Back ratio spread, earnings sniper spread, bull put spread extreme. This is my invention. Okay, I'm very proud of that. Snipex 4B, the collar, bull bang collar, a lot, right? It's just how to repair your trades. And his most recent one, crouching bull strategy, and Jade Lizard, he'll be teaching in a short while. Okay, so all courses and playbooks are up to 75% off. So do take advantage of our crazy once in a year blank market sale. Now, specifically for the options course, we have got 2 bonuses we're giving when you enroll right now. Number 1, you get all our trademark trading tools that you need for options trading, like the trade tracker, quick reference guide, EPS result summary sheet, and portfolio blueprint. Okay. Bonus 2, you will get a lifetime access to our options traders group, where again, we chat every day, 7 days a week, 18 hours a day on the Discord channel. This is our private community where we share trades with each other. Any question you have, you ask. Our team, our students are there to help you. So you have a community that's behind you every day to help you in your journey. You'll never be alone, okay? This is James. I'm surprised my options trading account up 35% year to date so far, right? And Mike also up 37% year to date. These are all our students who share all their results every day. Okay, so here is what you'll be getting in the options package. So options trading course level 1 will be 11 lessons over 22 hours of course time. That is worth $1,888 US. Options course level 2, which is the Iron Striker, 22 lessons over 38 hours of course time. Again, you can watch anytime, anywhere at your own pace. Whether you want to take 1 month to finish or take 3 months, it's up to you, okay? And you can rewatch again and again. That's priced at $4188. You get the 2 bonuses I mentioned. So the total value of the entire package is $8,076 US. We put everything to a package for a cost fee usually of $6,000 US, $6,076 US dollars. For today's crazy deal for Black Market, when you enroll right now, you are getting 75% off the entire package, everything. So you only need to invest $1,519. This is a crazy steal. It is the best deal you can get for all our courses or anywhere in the market out there. Nowhere can you get this deal for this content and this level of support and the unlimited access and the unlimited community. Nowhere else, I can tell you that, right? So you can scan the QR code to grab this deal right now, or you can click on that link below, all right? For the next 15 minutes, if you enroll for the fast action bonus, in the next 15 minutes, you will also receive an additional options trading live jumpstart workshop worth $300 that's taught by our resident trading coach, YY. By the way, our dear YY this year alone for options trading, he's up 92%. 92% this year. So he's one of our top trading coaches, and he's up like 52% on his investment portfolio as well. So he'll be going through a 3-hour live online session in addition to this entire course. So once again, scan the QR code, grab this offer right now, 75% off, only $1,519 US dollars, right? Okay, so go grab it. And I know you guys have got questions, so I'll do my best to answer as many questions as I can. And by the way, Bang Pham Van will be coming up very soon in the next session. You cannot miss it because he's teaching his brand new Jade Lizard strategy that has got over, if I'm not wrong, 85% win rate. I started to trade it myself. I made so much money on it. And he's going to teach it for the first time today. By the way, Bang Pham Van is right now in Texas in the US. If I'm not wrong, he's in Dallas, Texas. So he's waiting there and he'll be coming on shortly. But in the meantime, go grab this offer with these great deals, right? Okay, let me check this out. Okay. What's my take on VFC? I'm sorry, I'm not familiar with that stock. How many trades do I execute in a year or in a month to achieve my $200,000 profit? Okay, roughly I would say, wow, I do an average of, I would say an average of 1 trade a day at least. Yeah, at least 1 trade a day. So I would say that's about 20 trades a month because there are 20 trading days. So at least yeah, I would say I do at least 240 trades a year, at least minimum 240 trades a year. What's my win rate? For my cash secured put, 100%. 100% win rate for my cash secured put. For bull put spread, it's about 70%, all right, which I mentioned. This sir is asking, what level of basic trading do you have to know, or how many years of equity experience you need to have so you can benefit from options trading? A good example I can give you is Olivia, right? Which I mentioned. Olivia, when she took the options course about 4 years ago, she had 0 experience in investing. She has never bought a stock before. She just put her money in fixed deposit, right? And when she took the investor course and the options course together, within a year, she was generating consistent profits monthly. And she had zero experience, right? Someone is asking, Berhard asking, is this type of options trading available in Europe? Yes, I've got a lot of European students, a lot of students from Europe. Yeah. Right, I think that's all the questions I have, because I think most of my team have answered your questions on options as we went along the webinar, right? So 1519, that is your tuition fee to acquire a life skill that can generate a lifetime of income. Like I said, you know, whatever course you take an MBA, you take a bachelor's degree, you spend 30K, 50K, $100,000, it can't even guarantee you an income. And you got to bloody slog for 9 hours a day, is no fun. But, you know, with just this small investment, you'll probably make more money than your bachelor's or master's degree costs. But you have to put in the effort, of course. You have to put in the work. It's not magical that you just invest $1,519 and you got all the knowledge. No, you have to put in the effort to learn the course, to be in the community, to practice and practice, right? And like I said, to me, trading is a business, and it's one of the best businesses in the world. Why? Number one, it is very flexible. You can do it anywhere in the world, sitting on the beach, sitting at home, in the office, 1 to 2 hours a day. That's all you need. All right. No employees required. No need to pay rent. You got no competitors. You know, I always say that if I had a restaurant, I won't teach you my recipe. Because if I teach you my recipe and you set up the same restaurant next to me, you take away my business, right? But in trading and options, I can teach you, Bang and myself, we can teach you all our strategies, and it doesn't affect our profits. We still make the same profit because the market is so big. The market is big enough for everyone, you know? It is recession proof. Who cares if there's a recession next year? Who cares if the market goes nowhere for the next 10 years? I don't care. If the market goes sideways for 10 years, I still make money every month through options. I don't care if the market drops. I can still make money in options. Who cares about recessions anymore, right? And it requires relatively lower startup capital. Any business you start, you need a few $100,000 to start. But in options, you can start with a few thousand. With $3,000, I would say at least $3,000, you can start trading options. And yes, it is relatively low risk compared to a business. If you start a business like a restaurant, if it fails, how much do you lose? You lose everything, you lose 100%. But in trading, if you follow the risk management rules, we never risk more than 3% of our capital on any one trade. I repeat, we never risk more than 3% of our capital on any trade. So even if it's a losing trade, at the most, we lose 1, 2, or 3% of our capital, right? And over time, we will win more than losing trades. So we are like the house, okay? And one of the things I always tell my students is this: when you start, do not trade with real money first. Do not trade with real money first. Always start with paper trading. Start with a demo account. Only when you can make money consistently with a demo account, then you use real money. It's the same thing as being a pilot. Before you take off with real passengers, you must be in a simulator and take off and land and take off and land at least 50 times or 100 times safely before you fly with real passengers. The great thing about trading is that you can start with a demo account. In a business, you cannot say, I want to start a restaurant, but I don't want to take any risk. I'm going to open a fake restaurant with fake customers, with fake food. And if it works, I start my real restaurant. You can't do that, right? But in trading, you can do that. That's why I say trading is relatively low risk compared to any other business out there. Yeah. So I hope you learned a lot from me. I hope that you have been inspired, you've been enlightened, and the rest is up to you. I can only open the door, but you have to take that first step step to walk into the door and acquire these skills that are life-changing. So guys, thank you for watching, and stay back for the next session by Bang Fan Van, where he's going to teach his very powerful Jade Lizard strategy that has made me a lot of money recently as well. So take care, and I'll see you soon. And remember to enroll if you have not already enrolled yet. Okay, sorry. I have got a message from my team that we still have a bit more time before Bang comes on board at 2:30 p.m. So I can still take some questions if there are some questions here. Let me see if there are any more questions. If not, you guys can also enroll and ask questions, yeah? By the way, if you need the link again, this is the link. Scanning the QR code over here, and 75% off today at $1519 US. All right. Yeah, so Bang Fan Van will be coming on at 2:30 p.m. Singapore time. So do check your time wherever you are in the world. And like I said, Bang's in Dallas, Texas right now. So I think it's very early in the AM for him. Oh, it's 11:30 p.m. in Dallas. Oh, okay. All right. For Warren Buffett, apart from selling cash secured put, what other strategies that he has applied? Now, from what I know, Warren Buffett only does cash secured puts. He only does cash secured puts. From what I know, I mean, he could do other stuff that I don't know, but that's what I know, right? Can I purchase the course now and learn it later? Of course you can. Remember, all our courses come with a lifetime access. You can purchase the course now and watch it 3 years from now. It's up to you, right? But the earlier you purchase it, the lower the price you pay. Because remember that this 1519 crazy price is only for this period, right? It'll go back to 6,000 once this offer period is over, yeah? And also remember that every year we add new content, we add new strategies, we update the old strategies with new examples. So you're always getting new content every year with no extra charge. And a lot of my students, they say, one reason why we are so successful is not just the content, it's the community. That we are on the community chatting every day, where people share their trades, we critique their trades, and they share their results and all that. So you'll be part of this community, yeah? But bear in mind that we give you 30 days to take the course first before we put you into the community. Because if not, when you first go into the community, you will ask a lot of questions that is already in the course, right? So we will allow students to come into the course after 30 days, right? And then from there on, it's a lifetime access to all the courses. Dave, thank you, Dave from New Zealand. He said, I enrolled in your course last year, was truly worth it, ended up around 30% return, bearing in mind my mistakes as well. Well, that's pretty good. Dave, thank you for sharing. If we subscribe now, is it an online portal to access the modules? Yes, it's an online portal at piranhaprofits.com. Joey, don't touch zero DTE options. Trust me. All right, you will kill yourself. I know it's a very popular zero DTE among retail traders. There's a reason Bang Fan Van and we don't touch zero DTE. All right, it's not worth the risk. It is not worth the risk. By the way, remember that besides this options trading package at 1519, do check out all our other courses. We have got the investing course, the price action manipulation course, the REIT course, how to invest in REITs, and yeah, they're all going up to 60 to 75% off for this very limited period. So do take advantage of that, right? While we do have a bit of time, I'll just share with you a few more sharings from my students, if you will, right? And you can see they all trade very different strategies. This is Philip. He said, thank you so much for your program. I started your program since May and now up $18,000. All right. This is Philip from California. Mike, I'd like to share my winning trades for Spotify. Made 2 credit spreads on it, 1 bull put spread, 1 bear call spread, and I made 1,008 on this, right? You can make back your cost fee in 1 trade, you know, for many of them. This is yep, this is US as well. This is our student from Penang, who is an orthopedic surgeon. He said, so far 2023, year to date, my portfolio achieved 82% from taking long expiry call options, SLK and QQQ, beating the underlying NASDAQ index, right? Then we have got sharing my year-to-date result. Thank you for sharing your valuable knowledge through the courses and also your timely advice and guidance in the chat groups. You really went above and beyond in helping your students. I'm also very thankful to be part of the community, and I have learned a lot from our fellow members. I found combining knowledge from UIP and options courses really helped to boost my return. My favorite strategies are selling covered calls, cash secured puts, trading debit spreads, and even long DT options, right? She got 81% return, 81% return in her first year after the options course. And she was someone with very little experience as well. Yeah. Hi, Adam, can you clarify how you trade with very little cash using credit? Okay, like I said, if you don't have that much capital, then there are many strategies in options where you don't need much capital. Example would be debit spreads and credit spreads. You require much less capital. Then, of course, there are some strategies that you need a bit more capital, like selling cash secured puts, right? That's why we teach you all the different strategies, so that if you have got a very big account, you use certain strategies. You got a small account, you use other strategies, but they are all just as profitable. Yeah. So there are strategies for every occasion, for every different account size. Asanka is saying that, yeah, so for Bang Fan Dan, he actually holds long-term investment positions using certain option strategies, like his crouching bull spread, and I think he uses his bull bang strategy. You know, for me, I'm different. You know, for me, I like to hold the underlying stock, and then I just use options to create extra income on top of my stock positions. Again, it's a different approach, right? We all have our different favorite approaches. Have you found any successful strategies for intraday trading? No. I can tell you that intraday trading, I used to do it in the past, is too time consuming and is not as profitable, and the win rates are not as high as taking longer term swing positions. Our community, we meet online every day, 7 days a week, 18 hours a day, but no, we don't have any physical meetings, right? Although we do have a once a year annual event at the beginning of the year where we all meet up at Suntec City in Singapore for about 1 to 2 days, right? A physical event, which will be coming up next year, where we will meet physically. Yeah. Right. I know some of you are asking questions, and I know we have got, right now we have got thousands of participants online. So I know my team, they're doing their best to answer and help as many of you to enroll, because I know some of you may have issues with the payment, issues with the admin. Do give them some time, because like I said, we have right now a few thousand participants, but we only have that many people in our team helping. So if we can't help you immediately, don't worry, we will get back to you. We will call you to make sure that you can enroll in the course that you want to enroll in. Yeah. So don't worry too much about that. And again, this is the QR code that you can use. The level 1, level 2, together with the 2 bonuses and the fast action bonus, and that is 1519. You can scan this QR code and click on the link below, right? So with that, guys, I will end my part of the webinar and do have a rest before Bang Famban starts his session at 2:30 p.m. Singapore time. In the meantime, stay here while my team helps you to make sure you all get enrolled in this class.